you don't design your portfolio with normal markets in mind. You design your portfolio with the worst 1 or 2% of times in mind, because those are the times when you are most likely to break the magic of compounding. You're not trying to get rich. You're trying to avoid becoming poor.
Most of us just want to know one thing. What is the best way to invest? Decades ago, William J. Bernstein had the same question, so he decided to find out. That led him to become an early supporter of the simple, evidence-based approach of keeping costs low, diversifying widely, and not trying to beat the market. It's basically the philosophy behind modern index investing, and he shared it through several classic books, including The 4 Pillars of Investing.
You taught yourself investing in the 1990s, which I think is incredible. You had no financial background. You built your own models, completely self-taught. What really prompted you to get started?
Well, I live in a country that doesn't happen to have a functioning social safety net. So I knew that I was going to have to save and invest on my own. And I'm often asked, if my background as a neurologist helps me in terms of behavioral finance, and it really doesn't. What helps is simply having scientific training. So I did what I thought any scientist would do, which is that I read the peer-reviewed literature, the basic texts, I collected data, and I built models. And what gave me a bit of a leg up was that this was the 1990s, and that was hard to do. So if you could do it and you could get the data, which was really the most difficult part, then you were able to create models that were otherwise unavailable to the general public. They could be bought for thousands of dollars by professionals at that point. And so I created my own tools, and it occurred to me at that point that I had done something that was worthwhile to small investors. And almost exactly at that moment, the internet comes online in my benighted corner of the world in rural Oregon. And I started putting this stuff online. I ran into a guy by the name of Frank Armstrong, who had already put a similar book online, and he told me I should definitely do that. And I started writing things, and journalists started connecting with me, and that's how I got into the business.
You reached out to me over email after we spoke to Roy Dimpson, and honestly, it was, at first I thought it was a joke. I thought it was like some kind of hoax. And then when I realized it was actually you, it took me 24 hours to reply because I really struggled with kind of like an imposter syndrome to have a chat to you about finance, right? And I kind of wanted to ask, as someone who's self-taught, who associates with like pure academics that have written papers, you've written papers yourself, peer-reviewed, all of this stuff. Do you ever feel like that? Do you ever feel like a bit of an imposter in some of the rooms that you've ended up in?
Oh gosh, yes. All the time. When you find yourself in a conversation with, somebody like Rob Arnott or Elroy Dimpson, you start asking yourself, what am I doing here? The worst experience I ever had in regard to that was, about 10 years ago. I had already written a book about the history of world trade, and I get invited to, a national intelligence conference that's being held in Washington, D.C. with all kinds of spooks and four-striper military guys, and they expected me to say something useful, and I was petrified.
Yeah, I mean, what a scary thing to teach the people about national security that are in charge of it, basically, and stuff.
Exactly, yeah.
How do you think, I want to apply this to an average investor, because one of the things that I see with my encounters with normal people is they have a form of imposter syndrome of their own of, how do I know that I'm doing this right? What if I'm getting it wrong? What are the validation points that normal people that don't go to your level with it can lean on to make sure that they're doing the right thing with their investing?
Well, there's some very basic, very readable texts. And the ones that I always recommend to people are Burton Malkiel's Random Walk Down Wall Street. And then almost anything by Jack Bogle, the late, great Jack Bogle, will do just as well. And what they will teach you is that simply by having a passive indexed approach to investing, that over the long haul, you can beat 90% of professionals. I happen to manage, along with another fellow, a small charitable endowment. And we have a very simple model that takes us about 15 minutes a year to manage. And we routinely beat out people who are spending their entire careers trying to find active managers and do alternative investing. It's that simple. And I guess the trick is to just learn by doing it yourself and coming up with a good result over a 10 or 20-year period. You learn that you're going to do a good job. But you get validation from people like Bogle and Malkiel as well.
You also recommended another book recently, which is the predecessor to, I can't remember the author, you'll have to remind me, the one about how impossible it is to make accurate forecasts.
Phil Tetlock, yeah.
Yeah.
It's a book that I recommend to almost anybody who wants to live their life intelligently. And that's a book called Expert Political Judgment by a psychologist by the name of Phil Tetlock, although he's really an economist. And I'm reasonably sure one day the guy's going to win a Nobel Prize in economics, because what he does is he looks at forecasting as a science. And what you learn from him is that almost nobody forecasts at all well. And sometimes experts do particularly poorly in certain circumstances. And if you follow certain simple forecasting rules, you can actually make better forecasts than a lot of experts can do.
I think a monkey with a dartboard has been proven to potentially make better forecasts than the average professional over a long period of time. Like as in a chance could be better at forecasting.
Yeah, a monkey with a dartboard who knows a little bit of historical data and has a fairly simple algorithm. Yeah.
You're basically describing me there.
How do you, I mean, I find finance books very hit or miss. Some of them are like very easy to read, very kind of designed for the average person, and some of them are very technical. Are there any, like for example, Vicky Reynolds did a book on psychology of money, which I found really easy to read, very relatable. Are there any books you would, like what's the worst book you've read, and how do you go about choosing which books to read?
Well, I was, one of the heads up you gave me was, what's the worst advice you've ever got? What's the worst book you've ever read? And that's 90% of the finance bookshelf that you're going to see at any bookstore. Sort of what epitomizes that for me was a show that was very popular in the United States 40 and 50 years ago called Wall Street Week, which pushed the idea that the average person could pick stocks or time the market. And it was, their guests were people who manifestly had failed to do that when you looked at their actual track records. And so that's the sort of advice. I mean, 90% of what you see, or almost 99% of what you see, for example, on any financial cable channel is going to be awful advice. I mean, it's the better question is what is actually worth listening to and reading, because that's a much smaller, shorter list.
Yeah, I mean, would you then throw modern, like CNBC's Jim Cramer, would that all fit into that sphere of stuff that you think probably should just tune that out?
Yeah, what I like to say about CNBC is that if you turn off the sound, you'll learn a lot more, and it's a pretty good substitute for Animal Channel.
Yeah.
So how do you...
I want to say something in defense of Jim Cramer. I mean, it's an interesting phenomenon. You would think that listening to Jim Cramer, that he's a buffoon and a fool. But in fact, Jim Cramer was the editor of the Harvard Crimson. I can tell you they don't give that away for free. And I've never spoken to him personally, but I know plenty of people who have, who tell you that he's an intelligent person who can discuss finance as intelligently as you guys can do, which is at a very high level. But you don't make an 8-figure salary by discussing finance intelligently in the mass media. You earn an 8-figure salary by dressing up in a gorilla suit and jumping up and down on the desk and yelling "booyah."
His incentives warp or disguise his true acumen there, and the incentive is to stand there every day and say, "This is about to go mental," because that's what gets people to watch, right? And
it's all about eyeballs and selling advertising.
Yeah, I mean, we see that on YouTube in the game that I'm in, that, you lean negative, you get more clicks. And if you want views, you're just always going to pretend like the economy is about to collapse.
That's one of the many useful things that Tetlock writes about, which is there's this vicious cycle you get into where the financial media loves extreme predictions in one direction or the other. Either we're headed down the tubes and we're headed to the apocalypse, or you're going to go to the moon. That's what gets eyeballs and that's what sells advertising. And it turns out that the people who make those kinds of predictions have awful forecasting records. And so they appear repeatedly on the media because the media knows that they'll sell advertising. And the more they appear in the media, the more overconfident they get, which is also death to forecasting. So it's a spiral. It's a death spiral of forecasting inaccuracy. And you wonder, after you've been following some of these people for decades and decades, why anybody ever invites them back, because they're so disastrously wrong when you look at their track records. But the networks don't care about that.
No, and there's always new people entering the investing space, and if you speak with conviction, they're not gonna necessarily know those track records. And people latch onto one event. There's like, oh, they predicted the 2008 crash, but they've then predicted 10 other crashes since then that haven't materialized, and no one holds them up for that.
Yeah, that's a story that never ends. There's always somebody who was lucky, and it turned out that the accurate forecast was due to luck. I mean, I don't know of any forecaster who has consistently called the market over any period of time. There's always one lucky call, maybe two, and that's it.
I want to come on to your most famous book, The 4 Pillars of Investing. You say that the biggest investment risk isn't the market, but it's the person in the mirror. I definitely agree with that. There's so much psychology and emotions in investing. Do you still think that's true, or have you changed your thoughts?
No, it's the more I learn about finance, the more I realize just how true that is. I mean, here's the basic evolutionary psychology that's in back of that, which is we evolved to have a risk horizon of a fraction of a second or a few seconds. It's being able to react to the yellow and black stripes in your peripheral field, the hiss of the snake, that sort of thing. Whereas the risk horizon and the planning horizon in investing is decades long, sometimes in periods approaching a century. So we evolved in the completely wrong way to function in a post-industrial society where your risk horizon is so very long. And the best analogy I can think of is to think about the evolutionary history of the skunk, who evolved over hundreds of millions of years, or maybe tens of millions of years. And their response to the predator is to turn 180 degrees, lift their tails, and spray. That's how you survive as a skunk. Now, unfortunately, if you live in an environment where the major source of risk to you is a hunk of steel moving at 100 kilometers per hour, that is not a good strategy. All right?
Take one right up
That is precisely
the wrong end.
That's precisely and it's precisely analogous to investing.
Yeah. There is something interesting though. So there are people moving through the journey of investing, and in your lifetime, so you wrote the original book a couple of decades ago. You put out a revised version in 2023. I'd like to kind of ask two questions. What's changed, and were you right? Do you think you've gone along that journey and gone, yep, I was kind of spot on in terms of the 4 pillars, that kind of way of thinking about portfolio construction and stuff?
Well, of course, you can never be right about anything over the long term. I suppose if I was wrong about one thing, and it's a detail, but it's an important detail, is I always thought that investing on the bond side in corporate bonds and municipal bonds was one of the things that you could do. And I certainly learned during the financial crisis that during the really bad times, you want to have your risky assets and your riskless assets completely separated out. So take as much risk as you want with stocks, but on the bond side, that's your sleeping money. And that should be in the very highest grade of investments. So no corporate bonds, no local authority bonds. Keep it to sovereign and relatively short-term bonds to keep your duration risk down. So that's the one thing that I recommended that was wrong, I believe. Now, what have I learned since? Well, I think I've learned two things. Number one is I didn't pay enough attention to the Merton formulation of human versus financial capital. So the young person can't invest, at least theoretically, too heavily in stocks. Not because stocks become less risky with time, because they don't, but because the young person has an enormous amount of human capital. Whether you're an American or a Brit, you probably have $1 million or $2 billion of human capital ahead of you, of earnings and savings. And that, for most people, looks like a bond. So when you're young, you can't own enough stocks, even if you have, a $100,000 deferred savings account or a £100,000 savings account. That still is only a tiny fraction of your total capital, which for the most part looks like a bond because most of your capital is human capital. So I didn't understand that, and I gradually grew to understand that with time. And then the second thing is sort of a counterpoint to that, which is that you don't design your portfolio with normal markets in mind. You design your portfolio with the worst 1 or 2% of times in mind, because those are the times when you are most likely to break and interrupt the magic of compounding. If you sold in 2008, 2009, it might have been a while for you to get back in the market, and you lost 50% of your wealth by doing that. So the trick is to hold enough riskless assets, invest a little more conservatively than you think you otherwise should, so that you don't do that. Now, those last two, the two things that I've just told you are in contrast or in contradiction to each other. And the trick is to learn where your pain point is during those bad times. So it's theoretically dictated that you should invest 100% of your investment portfolio when you're young in stocks, but you may learn that you can't tolerate even that.
Okay, T, talk to me about your attitudes towards risk.
I mean, I like a bit of risk in my investments, but I definitely would say since the podcast, I've toned it down a little bit, not quite as gung-ho and like carefree as I was in risk. So yeah.
Yeah, shooting from the hip all the time, weren't you? Yeah. I think personally that you should take risks, but it should always be in areas where you have a unique skill set, an edge, expertise, like your job, things like this.
Definitely.
One area that I wouldn't take any risks is compliance.
Yeah, the risk changes as you grow in business and you need to be on top of it, which is why we partner with Vanta.
Vanta automates a lot of risk processes and helps you see your risks in a centralized platform so you know what really needs your attention.
Besides risk, the main thing Vanta does is automate compliance with security protocols you need to scale, like GDPR, HIPAA, ISO 27001, and SOC 2.
The beauty of Vanta is they make it easy to prove you're compliant with these standards, saving you up to 90% of the time it takes. And on average, $500,000.
If you know what these acronyms like SOC 2 are, you probably need Vanta. You can book in a demo at vanta.com/making money. There's a link in the description. In the podcast, If You've Won the Game, Stop Playing, you mentioned that people are overconfident in investing, but they underestimate their appetite for risk, so that when the market goes down, they think they can tolerate a 20%, 30% drop, but then they can't, and then they sell. So if you're suggesting that young people, which I agree with, should be more in stocks because, you know, they've got more time, they've got a bigger horizon. If they're, for example, 100% in stocks and the market crashes, how do they kind of combat this desire to sell?
The practical advice that I give to young investors, to investment virgins, is the way to call it. If, you know, it's looking at something in a spreadsheet is not the same as living through a real bear market, because markets don't crash without a reason. They crash because the world looks like it's going to end, at least financially. And so it's learning how you're going to respond to that. And what I tell young people to do is to start out at about 50-50, okay? And then when the market starts to get really choppy, reevaluate that 50-50. Maybe you're doing fine with it, okay? So you go to 75-25. And maybe, you know, there's a market crash when you're 75-25 and, you know, you think maybe I should go to 100. Well, God bless, okay? But you may find out that, you know, when the market falls 20 or 30%, you feel like you're about to throw up. And that is the message to a 50-50 portfolio is suboptimal for a young person. But a suboptimal allocation you can stay the course with and you can execute is better than an optimal one you can't.
Yeah, I like your thinking around this because you said it beautifully in an interview once. You're like, I just don't want to go near the cliff. I don't want to go near the edge. I don't want the optimal that might get me to a point where it fails or whatever. So you're saying it's okay to be suboptimal because you could have a 10-year bull run, couldn't you, where you don't find out what a 20% dip is like. And throughout that 10-year period, that younger person's potentially been underinvested. But you're saying it's okay as long as when it lands, you don't end up, you know, selling or running away.
Exactly. You don't want to be the person who sells at the bottom. That is the worst thing you can possibly do. That's much worse than being 50-50 throughout your whole life when you should have been 100-0.
How many people do sell at the bottom? You know, when the market's dropping, that's a feature of more people selling than buying, right? So do you have any grasp on that? How many people that affects?
Well, yeah, that's a really interesting question. What any academic finance maven will tell you is that's a nonsensical statement, because for everybody who sells, there's someone who's buying. Okay, when someone unloads his or her shares of stocks, there's somebody on the other side who's buying them from them. So the really interesting and much more salient question is who is selling and who is buying. when the market is at the bottom? And the answer is that the poor get poorer and the rich get richer. The person who is buying at the bottom is generally someone who's very wealthy, who has a large amount of riskless assets to deploy in that circumstance. And the person who is selling is the person who is 100% in their ISA or their Roth 401k, who's never encountered a bear market before, and they panic and sell at the bottom. And they are generally selling their stocks to someone who's got a lot more money and a lot more experience than they do.
Do you think there's a consolidation then from the many to the few in those moments? You get novice retail investors, say, exiting their portfolios and then they're just being cleaned up by more sophisticated, richer people?
Yeah, it's a mechanism of increasing inequality. I'm not sure that Piketty ever wrote about it, but if he didn't, he should have. It's a redistributive mechanism. It's how the rich get richer and the poor get poorer. The great feminist writer, Gloria Steinem, said that the rich plan 3 generations ahead and the poor plan for Saturday night. And that's exactly what's happening here. The richer people who've had money for 3 generations, they know that markets come and go, and they know also to keep a fair amount of safe assets around so they can pay for the groceries and buy stocks when the excrement hits the ventilating system.
I love that expression.
When the shite hits the fan.
Well, you had to dumb it down. You had to make it all crude.
I just want to get this demonetized.
This is a podcast. We can do that. Right?
Yeah, we can do that. We could do that. You said it better than me.
Definitely.
I want to come back to the human capital point, because I think what you've done there is describe something that you've described it in a completely different way to how everyone else does. And what everyone else basically says is, you've got 40, 50 years ahead of you. You don't need the money. So, go long on stock market and swing for it. What you've basically said is, actually, your biggest asset, you've got a load of money tied up in your ability to work, your labor. So any money you put in the stock market is tiny relative to that anyway. So you might as well go for it. And I think that helps people really think about it in a different way. It's kind of like if you think your portfolio is also made up by your potential earnings over a lifetime. So I just wanted to underline that for the audience of it, because I think it's a really nice way of thinking about it.
Yeah, they're complementary concepts. I mean, they both work well.
Yeah. They get you to the same outcome. But I think a lot of people will hear, you've got 40 years, just go for it. And they'll think, oh, I don't know if I want to go for it. Whereas if you go, well, you've got 2 million quid there sat in yourself, and you're only putting 100 quid a month in the stock market, so it's not really that bad, is it? I think they would probably go, oh yeah, okay, I can get behind that a bit more.
Yeah. Over a 40-year period, you are guaranteed to encounter financial conditions that will scare the wits out of you. Mm-hmm. You will be frightened at many points, and the trick is to pick an allocation that will get you through those times.
Can we talk about the allocation that you have around and the thoughts you have around retirement income, and your preferred method of safe is, you call it a tips ladder. I think these are inflation-linked bonds, which we would have in the UK. They're called tips. Is that right? In
the United States, they're called tips. You, I think, refer to them as linkers, right?
Yeah, linkers. Yeah, linkers. These are popular within defined benefit pension schemes in the UK because they provide that inflation-linked income. But can you just, you've said, T alluded to it a minute ago, if you've won the game, stop playing. So can we just talk about that concept first and then move into how you're structuring that with these products? Yeah,
I've been quoted widely as saying that I want to get out front that I stole it from somebody else, a guy named Ron Ryan, who is a pension consultant. And what it basically, and it's also been misinterpreted. People have interpreted it as saying, when you've made your number, when you have enough to retire comfortably, you sell all your stocks. And no, that's not what it means. What it means is you identify the size of assets and the amount of assets you need to keep you in groceries and keep a roof over your head and to keep you from, being under an overpass. Just your bare minimum. And once you've acquired that, you should put that into safe assets that will adjust for inflation. So in the UK, you're very fortunate. You've got linkers that go out 50 years. So you can buy linkers that mature pretty much each and every year, and you are guaranteed to have that amount of inflation-adjusted income, as well as a bit of a coupon along the way. In the U.S., it's a little harder because our tips only go, our inflation-adjusted bonds only go out for 30 years, and there's some holes in that maturity ladder as as well. So that's what you want to do. And there's something that's widely derided in the United States, and for very good reason. It's called the 4% rule, which is you spend 4% of the initial amount, and then you raise that with inflation. But it turns out that if you take a 30-year TIPS ladder and you amortize it at current yields over 30 years, you can withdraw about 4.5% and be perfectly safe for 30 years, and then you fall off a cliff. So if you're 65 years old, you have the risk of maybe running out of money at 95, which is not a great risk, but there's a chance it might happen. If you do it at age 70, you're absolutely safe. You got to live to 100 before you'll outlive that. And if you're in the UK, you don't have to worry about that because you have the 50-year linkers. So that's one way of doing it. Now, there's another way of doing it, which is to buy an annuity. But at least in the United States, annuities, which will last your lifetime, no matter how long you live, aren't adjusted for inflation, and that's a real risk. So that's why I prefer TIPS to regular commercial annuities. Now, I think that you can buy inflation-adjusted annuities in the UK. Is that not true?
You can, yeah.
Yeah.
So they'll lift the income, but you lose that capital, don't you? So
yeah, you do.
Yeah, but maybe you could use a mix of the two. You're just really basically saying, the thing that to keep the roof over my head, that money is going in the safest possible vehicle that's going to guarantee me an inflation-adjusted income. And then with the rest of your portfolio, assuming you've got money left, are you then going, okay, equities, and that's the spicy money. If that does well, I get to live well.
Yeah, it's the money for living well, and it's the money for your heirs and your charities as well. You guys may not be thinking about that, but at my age, I've got kids and grandkids, and I want to make sure that they don't live under a bridge either.
Do you think inflation is the biggest risk to investors?
There's two big ones. That's the first risk, and the other risk is the risk of losing your discipline and interrupting compounding. There's the Charlie and Warren show. Charlie Munger and Warren Buffett do interviews, particularly at the Berkshire annual festival that they have. And there's one famous interchange where Warren Buffett says that my entire life has been a tribute to the magic of compounding, and to which Munger replies. Munger only replies to about 10% of the things that Buffett says, but when he does, it's always a zinger. And his response to that was the prime directive of compounding is to never interrupt it unnecessarily. And so that's the biggest risk that you have during a bear market. And then inflation, is inflation a risk? Yeah. How do you protect against inflation? Well, imperfectly, but you do the best you can. And one of them, a way of doing it reasonably well, but imperfectly, is with inflation-adjusted bonds. And then, if you own nominal bonds, keep them short, for God's sakes. Don't invest in long-term nominal bonds that can get absolutely creamed. I mean, the biggest losses in the financial markets over the long term aren't from stocks. It's from owning bonds during long periods of inflation. That's be truly catastrophic. And then, you can own a few commodities producers. If you have to, own a little bit of gold. There are people who think that Bitcoin does it. I'm not convinced at all.
Let's explore that a bit. So why aren't you convinced by Bitcoin? What don't you like about it? Because
I've seen the movie and I know how it ends. I've read enough financial history that you see these enthusiasms where people think that, the financial world has changed and this time it's different. And that they've discovered the financial equivalent of the fountain of youth, and you see it invariably ends badly. And there are certain sociological markers that you see all over the place with crypto. There's a famous quote, which is probably a bit apocryphal, from Joseph P. Kennedy, where he said he knew to sell at the top in 1929 when the Shoeshine Boys started offering him tips on stocks. Well, what you see now is you can't get into a Lyft or an Uber cab, and about 1 out of 3 of your Lyft drivers are investing in crypto. That's a bad sign, okay? When people quit well-paying professions to speculate and day trade in an asset, that's always a bad sign. Well, we're seeing that with crypto. There's a third thing that you see as well, which isn't as well remarked upon, which is that when you express skepticism, you're not met just with disagreement, but you're met with outright hostility. And I can remember, for example, back in the 90s when when somebody would express skepticism about internet stocks, that they weren't just told they were wrong. They were told they were idiots and they just didn't get it. You just don't get it was the classic response. So we're certainly seeing that with crypto as well. And the final thing is when you see extreme projections, So crypto, Bitcoin isn't just going to go to, $200,000 or $500,000. It's going to go to $5 million. It's going to replace gold. When you see those sorts of extreme predictions, that you're headed for trouble. We're seeing all four of those things. Does that absolutely predict disaster for crypto? No, but I sure wouldn't be betting the farm on it.
You just broke T's heart.
I was like, how do I come back at this without aggression?
You're an idiot.
Lies. No, I definitely.
You can call me an idiot, and then you'll prove my point.
Yeah.
He's put me against the wall.
Checkmate.
However, I definitely agree with some of the points you made, but it seems that every 4 years or whenever we're in the bull run, that's when you hear Lyft drivers talking about it and Uber drivers, and you see on the news, Bitcoin will be 500,000 by December. However, once the market crashes in the 4-year cycle, I don't know if it's going to happen again, but every time the market crashes, no one talks about it again for another 3 years. And then, so what you're saying is right, but I feel like that's what happens as we approach the top of the market, and then Bitcoin crashes, everything else in crypto crashes, and then everyone's quiet for 3 years, and then we get back to the bull run and everyone starts talking about it again.
Is there any way that Bitcoin could change your mind at all, Bill? Elroy Dimpson sat there and said, I wouldn't look at it because it's got no history, but obviously he deals in the hundreds of years, not the tens.
Well, it's not an income producing asset. That's the problem. It's a currency. It's cryptocurrency. And the important word there is not crypto. The important word there is currency. So no one would put a lot of their, let's assume that it does become the medium of exchange. Well, had you invested in Swiss francs or in Japanese yen and just put them under the mattress in the year 1900, you wouldn't have done terribly well. And here's where a little bit of history helps. In the 1920s in the US, there were 2,000 automobile manufacturers. Now, the automobile certainly changed the world. It certainly changed our economy. Did you make any money by investing in any of these companies? The odds of your picking out the 3 or 4 companies that succeeded out of those 2,000 is close to zero. The same thing with the internet bubble during the late 1990s. For every Microsoft and every Amazon, there were 1,000 pet.coms, and the odds of your picking that winning lottery ticket are very, very small. So, and it's the same thing with AI. I have no doubt that AI may be a very transformative technology, but are you going to be, making a lot of money by investing in the companies that are throwing capital at it now? I really doubt it.
Do you think then a broad global index approach is the best approach just to capture the market with all that considering? Because you're basically saying, how could anyone guess where any of this is going?
Yeah, John Bogle was very fond of saying that, searching for very, very highly profitable stocks is like looking for a needle in a haystack. So the solution to that is to buy the whole damn haystack.
But what happens if certain parts of the haystack become very big compared to the others? So in the market-weighted indexes that we have, the capitalization-weighted indexes that we have, AI is obviously a massive force. So I try and buy the Globe, and £5 of it's going into Microsoft or whatever every £100 that I spend. Does that concern you?
It's an interesting, again, Bogle had an interesting way of explaining that, which is that if you think about it theoretically, it shouldn't work because you're going to wind up with these, a concentrated portfolio of these vastly overvalued companies. But if you look at a bumblebee, it shouldn't fly either, all right, aerodynamically. But fly it does, all right? And it's the same thing with investing passively, is that if you invest passively in the total stock market, you wind up with these very top-heavy portfolios, but golly, in the long term, they do pretty well relative to the way everybody else does. Now, is there a way out of that? Well, there is, and that is to have a value tilt. If you tilt towards less expensive stocks, you wind out chucking out the Magnificent Seven, and you may save yourself some money. You may make some excess profits. The problem is that approach hasn't worked terribly well over the past 20 or 30 years, at least not in the U.S. It's worked well abroad. So you pays your money and you takes your chances. You can either approach, I think, is a valid approach.
Yeah.
But the thing is, even with value investing, you should do that passively and at least own the haystack of value companies, because in that haystack are going to be a couple of very profitable needles.
Tremaine, do you want to hear a fun fact about tax?
Don't get me excited. I'm all about tax facts.
Are you?
Yeah, I love a bit of tax.
This is new to me. Well, okay. So in 1970, the tax code was around 1,500 pages. Now, today, 2025, it's 22,000 pages.
Hefty.
Very. So there's around 10 million words, and there's more written about tax than any other type of law or legislation in the whole of the UK. It's one of the most complicated tax systems on the planet.
We know how complicated tax can be, but we've got a tool that can help. TaxZap.
TaxZap make it really easy to file your self-assessment. And if you're one of the 12 million people that needs to do that, the deadline is coming up on January 31st.
With TaxZap, you don't need to have a lengthy back and forth with an accountant. And you don't need to navigate the complexities of HMRC on your own. You just sign up, add your info, and they'll guide you through it. So you can submit your tax return in as little as 15 minutes.
We've left a link in the description. Prices start from £49. But if you use the code MONEY10, you get 10% off your first tax filing. That's MONEY10. There's also a QR code on screen if you want to use that. You speak of the ability to kind of stay the course and to be value leaning, or, you know, the amount of people that have sat here and said the UK market is undervalued for a long, long time. It's having an okay moment at the minute, but it stayed undervalued for a long time. And I imagine that's really going to test your mettle if you then look over the pond and you see the American market delivering 24% return, say, or something like this in a single year. So I buy global just because it's easy, because I don't really need to think about it. Removes me from the decision-making process.
And things can look, much worse for underperforming markets than, for example, the UK does now. You could buy the entire UK market in 1974 for a couple of months of Saudi oil output.
Yeah. You could buy the whole UK market for one apple. So, it's the size and scale of the American market is massive. And one thing I think is, if there is an AI bubble and it pops and we go the other way, how painful is that going to be to a global investor who's bought into this thing of, well, I'll buy everything because then I'm protected slightly. Are they protected?
Well, you're going to lose a big chunk of your U.S. holdings, and the U.S. is now about 60% of the global stock market. So it's going to hurt a little bit, but that comes with the territory. There's no return without risk, and what risk means is you're going to lose a truckload of money from time to time. You have to be able to live with that. I mean, Keynes, there's a quote from Keynes. I can't quite do it word for word, but he says it's not just the inevitability, but it's the duty of the equity investor to, from time to time, lose money and do it without regret or reproach. I think it's pretty close to his exact words.
And do you see any argument for indexation being a bad thing outside of, it's good for the investor, but do you see it as bad for the markets, for capital allocation, for what the market was set up for?
There's two arguments against indexing. One is that if enough people do it, you lose price discovery. So when 99% of people are investing in an index, then valuations will get way out of whack, and more importantly, capital will get misallocated into companies that perhaps they shouldn't be allocated to. And I think that's completely and totally specious, because even if 90% of the market gets indexed, the 10% of people who are investing actively are still going to be more than enough to do adequate price discovery, because passive investors turn over their portfolios only about 10% as much as active investors do. So if 90% of the market is indexed, still 50% of trading will be done by active investors, and that's more than good enough for price discovery. So that's one argument. Another ancillary argument to that is, well, when everybody becomes a passive investor, then active investors will probably be able to make money. And if you think about it, that makes no mathematical sense, because if 90% of the market is invested passively, then the other 10% of the market is still the market, okay? And the people who are investing in that 10% of the market that is not passively invested will still be investing against each other. They will be getting the market return minus their expenses. So you're back where you started. So even that's not true. Now, what is true, but maybe just theoretical, is the argument that when you have 3 or 4 great big index providers, so your BlackRock, your State Street, your Vanguard. Your Vanguard, you're in a world where you have one great big investor who will be inclined to preserve the monopoly profits of a small group of airlines or a small group of automobile manufacturers. And Jack Bogle worried about that a little bit. I think that's a theoretical argument. There's no empirical support for it that I can see.
Do you not worry then that Vanguard are sat on every board of every company in the S&P 500? Does that not concern you?
It doesn't concern me, but it will certainly concern people in the legislatures and the executive branches, and maybe even in the judicial branches. I think that if that gets to be a problem, it will become apparent, and I think it'll get acted upon.
Do you think the answer is to make them passive in terms of their influence? They've got like a seat, just they don't really get any say in the room.
That would be one solution, is take away their voting rights.
Yeah. And you mentioned before that you manage a small fund for a charity. Is that passive, or are you actively managing?
It's passive. I mean, we use Dimensional, which I think I don't.
Please explain what that means, if you don't mind.
Yeah, basically, what Dimensional does is they are tilted investors towards small and value stocks. So they invest passively. They use a very mathematical criteria for just basically chucking out the stocks they don't want to invest in. And they still own a very large number of stocks. They don't trade actively at all. They don't try to do any fundamental analysis at the individual stock level. So I use them because they are value tilted for the endowment that I use. But it's not radically different than what Jack Bogle does. It's just that they chuck out the growth stocks.
And is this like farmer French like kind of thinking? And does that produce a higher expected return over the long run? To have that lean towards value or small companies is another factor?
Well, over the past 70 or 80 years, it certainly has. In the U.S., you have to go back to 30 years before it works. So you needed to be very, very patient. And the $64 question is when too many people invest like Fama and French, and an increasing number of people are doing it, does that take away the premium to investing in value in small stocks? That's a very good question. I think the answer to it is that, yes, that premium is still there, although it may not be as large as it's been in the past. Yeah,
30 years is a long time as well, isn't it? Because that could be your whole investing lifetime, basically, that you might be wrong.
Yeah, I've been using that approach, and we've been using that approach in this particular endowment over almost that entire period of time, and we're very happy with it. But you had to have been very patient.
Yeah, and the thing is, again, though, coming back to what you said at the start, as long as it's good enough. I mean, it's not like you're not getting a return. You're still producing returns, even if even if these are, it's not optimal or whatever. It still gets you to the end destination. I'd like to
investing isn't a game where you're trying to get the highest return. You're not trying to get rich. You're trying to avoid becoming poor. And those are two entirely different things.
Yeah.
Do you think people don't think of it like that, though? That's a very refreshing view on investing. But I feel like a lot of people think investing is how you get rich. Like thinking of investing as protecting your capital and making a bit of money rather than getting rich. Do you feel like a lot of investors don't really see it like that, and that's why people run into trouble?
Yeah, that's the problem with the mainstream media and the financial media in general, is they focus on the things that look like they're going to get you rich, timing the market, picking stocks, and the theory behind that, the philosophy behind that, is you want to make as much money as you can. No, you don't. You want to avoid being poor when you're old. There's a famous episode in American finance. It was a hedge fund called Long-Term Capital Management, which turned out was very ironically named. And these were the most brilliant people in finance, one of whom was Robert Merton, who we've already talked about. And they had this algorithm that produced enormous returns, very high returns, until their leverage finally caught up with them. And again, as always, the last word goes to Warren Buffett, who said that to make the money they didn't have and didn't need, they risked the money that they did have and did need.
Yeah.
And they end up bankrupt.
Yeah, there's a book called What Darwin Taught Me About Investing, and there's a story in there about the deer approaching the lake and how the deer knows there's predators at the lake, and the deer has two choices. They can approach the lake and get eaten and they're dead, or they can wait and stay thirsty but not get eaten. And we should do those. We should take the choice of surviving another day. And, we go, oh, well, I missed out on the big thing, but I didn't completely wipe out. And it comes back to your labor point. Your labor is finite. You only have so much of it. And once you've spent that capital, it's gone. So you shouldn't be swinging for the fences and basically peeing your labor up the wall, right? And I think that's how I changed with my view of investing over my investing journey. I outrun inflation and I use it to make the fruits of my labor work for me. And that keeps me honest and stops me trying to pick stocks.
Yeah, it's a good way to look at it.
Yeah. Okay. So what I would like to talk about now is expected returns, if you don't mind. What does the next 100 years look like for investors, do you think? I'm sorry, I know you said forecasts are pointless and I'm asking you to make a 100-year forecast, but...
Well, the way I would look at it is the same way that, Elroy Dimpson, who you know well, looks at it, and the way that Ed McQuarrie, who you also know well, looks at it. That's how we connected, was through Ed. And if you just look at it objectively, you say, okay, U.S. stocks yield about 1.5%, and there's a real rise in dividends of, at best, 2% per year. So that gets you to 3.5% real return. And maybe if you're lucky, you'll get 4.5%. You throw in some things like buybacks, although I don't really buy those either for a number of reasons. And then you go abroad and you say, okay, well, in the UK and in Europe, the yields are closer to 3 or 4%, but then your growth isn't as high. So you're back to probably, 3 or 4% real return. Now, here's the problem, which is that if you have that as your central estimate, say, being optimistic, a 4% real return, then you ask, what's the noise around that? So, and I'm going to try and do this in my head, but if you have a standard deviation of stocks of 16% per year over 100 years, you divide 16% by the square root of 100, which is 10. So you've got a standard deviation of about 1.5%. Two standard deviations below 4% gets you to a 1% real return. Two standard deviations above that gets you to about a 7% real return. So I will tell you forthrightly that I can estimate fairly accurately with reasonable certainty that the return over the next 100 years of stocks will be somewhere between 1% and 7%. You just don't know. And there's just too much noise involved even at 100 years. So you just don't know. And you have to plan for that eventuality. Now, there's another factor here, which is mean reversion. All right. If stocks revert back to anything even close to their traditional valuations, then you're in a world of hurt. Then you're starting at 4% and you're heading south.
But your assumption there of 1% to 7%, they were real. So that was inflation adjusted. So you don't see a world where they're negative in real terms.
Not over 100 years. You've got to live to 100 years to be even guaranteed of that.
Yeah. And then
over 30 years, it's very possible to get a negative real return in stocks now.
Yeah. And we're in a higher inflation environment. And what does someone do if with that sort of information?
Yeah, you do the best you can. You protect yourself as best you can. And the way you do that is if you're going to own, if you're going to be retired, certainly linkers and tips are a reasonable way of protecting yourself against inflation. If you're going to own cash and bonds and they're nominal, that is, they're not inflation protected, don't keep your maturity short, certainly well below 5 years. If you're willing to take a risk on a value tilt, then that is actually, for a number of reasons, a good way of having some protection against inflation. And finally, there's nothing wrong with owning a couple of commodities producers. Now, you already own those when you own the whole market, okay? But maybe you want to tilt a little bit more. So at least in the U.S., you can own gold stocks and energy companies and base metals producers reasonably, in reasonably diversified fashion, reasonably inexpensively with ETFs.
I want to talk to you about retirement now, and to link off that point, I want to ask, if people are saying, "Oh, maybe it's 1%, maybe it's 7%, and it would serve me well to work to the lower estimate," how can people ever hope to accumulate enough wealth to retire under, defined contribution sorts of pensions that we've got now?
Well, this is a very unpleasant subject that has to be approached. Let's take what Ed McQuarrie and I call the toy model, which is that you're going to live and save for 30 years, say from age 30 to age 60, which is not unreasonable because most people don't get clear of their student debt until they're 30 years old. So you're working for 30 years, then you're going to retire at age 60, and you're going to live until the age of 90 when you push up the daisies, okay? So for every year that you're working, you are retired for a year. You have to fund retirement. And if you get a zero real return on your portfolio, that means you have to save 50% of your portfolio, 50% of your savings. You have to save 1 year of income, or of living expenses, I should say, for every year that you are working. Okay, well, you can massage that model a little bit and make it a little less grim by assuming a real rate of return over 30 years or 60 years, let's say, both retirement and working. If you can get a 2% over that entire period of time, which is no mean feat, because remember, you're investing in both stocks and bonds, then your savings percentage goes down to 30%. And in fact, when you look at well-run defined benefit pension plans, which in the United States are very rare in the private corporate world now, that's what they do. And that's what some good public plans do as well. When you look at the best public retirement plans, the best funded ones in the United States, the best funded corporate plans, they put away 30 cents on the dollar for salary. Okay, that's what you have to do. So this business of having a 401k in the United States, and you put away 7%, and your employer puts away 3%, and you get to 10%. Somehow you're going to be able to retire on that. That is a cruel fantasy, and that's the hard reality here. Everybody wants to have the old style defined benefit plans, and the problem is those are very expensive, and most of them folded, and U.S. companies are running away from them as fast as they can, just for that reason. They don't want to put away 30%.
I know
which is what you have to do if you're going to do it on your own.
Yeah, I know this is the focus of your research at the minute, and I know you're working on a book with Ed and stuff. Do you see anywhere in the world that has solved this problem, or do you see any hope there? Because 30% is a lot, right?
There are some companies that do that. IBM, for example, bless them, still has a good defined benefit plan, and that's what they do. I have one child who works for a large city in a responsible position, who between she and her own private contributions puts away 30% into a defined benefit plan that looks like a pretty good plan. There are some entire countries that do a pretty good job of it. The Netherlands is certainly one. They have a very, very, very nice plan, national pension plan. The Scandinavian countries, particularly Iceland and Finland and Norway, are doing a pretty good job of funding their national pension plans. And there are some other places, Australia is doing a reasonably good job as well. There are some nations that are absolute disasters. The pension benefits, if you're a French person or an Italian or a German, are very generous. Unfortunately, those plans are very, very underfunded. And France right now, as we both know, is heading toward the precipice just for that reason.
What do you think of the UK scheme then? The triple lock and the state pension specifically?
I don't know nearly as much about it as you guys do. From an American perspective, the national insurance, the national pension that you have looks really skimpy. If you're an American, you can get, on average to about 50% replacement. In the UK, it looks like you're at around 20 or 25% replacement with a maximum benefit of, 12,000 quid per person?
Yeah, it was never designed to be the thing. It's always meant to have something alongside it. But I think that getting people to understand that is the hard thing. And the problem with the state pension scheme, because of its pay-as-you-go nature, is it's very expensive and not that generous. So it's like just a terrible all-round solution, because current workers today are paying for the people who've retired. And then when you've got an aging population that's skewing like this on the population triangle, all of the demographic issues that this causes. And it doesn't look very sustainable, even though, as you describe, it's skimpy. If you've got to only live off that, you're living in poverty.
Yeah, and you're going the UK is going the same way that the United States is going, which is towards defined contribution plans, what we call 401k plans, I guess what you guys call
auto-enrollment pension schemes would be the work-based schemes, but they're just DC schemes is what we would call them.
And it's like everybody's their own Warren Buffett and is funding their own retirement. Everybody has their own pension plan. And I don't know what the UK data look like, but the US data is very grim. The average 60-year-old, the person who's just about to retire in the United States, the average is deceiving. But the median 401k balance is about 100 grand of total assets, and total retirement assets maybe are twice that. $200,000 doesn't get you very far.
8K a year if you're doing your 4% rule from the Trinity study. But
yeah, 4% of 200 grand is $8,000 a year. Good luck.
Yeah. It is concerning, and I wish. I mean, just to give you a stat from the UK, 90% of people don't even log on to their DC schemes. They don't know what it's invested in. They're in these default funds, which are kind of like Goldilocks funds. They have like 15 million people in them, and they tend to skew conservative because not too hot, not too cold, and people are just not engaged at all. In the UK, people can tell you exactly the deal their mortgage is on, but they can't tell you where their pension's invested.
I had a funny experience. I was teaching a class at our local university on just this subject, and we were I was talking about the French system where it's politically unfeasible, untenable to raise the retirement age from 62. And as I'm talking, I see this tall guy at the back of the room, and he's grinning and nodding his head. And I said, "Okay, what's on your mind?" And he said, "Well, I'm Spanish." And he said, "We just raised our retirement age to 67. So we're smarter than those French people are."
Yeah, we run in that way. I mean, ours
is going up.
is creeping up. Yeah. I think the expectation for someone my age is that the state pension age will be pushing near 70. And I know a lot of the like the NHS pension schemes and things, the defined benefit schemes that do exist in the UK, they're linked to those ages, and it feels like they're running away from people, basically. As then you've got to ask, what kind of quality of retirement will you have if you're not getting it until your 70s?
Yeah, I mean, I suppose the advantage, this is a cruel thing to say, but the advantage of being an American is we have this crummy social welfare system, this crummy social safety net, so people never got used to it.
Yeah.
Okay. And unfortunately, if you live in a country that has a good social safety net and it's not well funded, you're headed towards a brick wall.
You get one generation gets it good. It's basically what's happened. We've had one generation who got good defined benefit schemes, and they basically
all the houses.
Yeah, they basically pulled the bridge up. It wasn't their fault. I hate this kind of the boomers screwed everyone. They just worked with the system they had. And if you look at what they grew up through, they went through the 70s. They've been through lots of crap, and I dare say at the start of it they had no idea what was coming. But it does seem like the policymakers in the UK made the defined benefit scheme so generous that they could never be done again.
Yeah, that's right. I mean, the boomers screwed everybody else, no doubt about it.
Okay, question for you then. That's a bit on the nose. Will everything sort itself out when that cohort dies? Will the boomers pass through the system and the big block of population? Do we end up with loads of houses everywhere? Does the pension issue disappear? And is it like, there's plenty of room now?
No, I think I'm sort of a glass half empty sort of guy when it comes to this. I think it's going to be a real shit show. I think what's going to happen is you're going to see just increasing inequality. You're going to see a generation of young people, a minority of that generation, who are very lucky and are going to inherit from their parents. Okay, they're rich boomer parents, and then there's going to be the 70% of everybody else who are going to be living a very precarious existence, and that it is not going to bode well for the body politic. You're already seeing how it's playing out in the United States, which is that there's increasing wealth inequality, and it's not the fault of the fact that there's not a generous safety net. It's the fault of immigrants and transsexuals.
Mm-hmm. You get populist politics because people just feel like my life's crap, and someone comes along and goes, "Well, it's their fault," and it's like, "Oh, well,
that makes sense."
That makes sense. Yeah,
exactly.
Yeah, not.
It's not the fault that the biggest legislative accomplishment of the current administration is a massive tax cut for not the 1%, but the 1/100th of the 1%.
The lights have turned on. Enjoy.
It's getting a bit dark.
Yeah, we're getting some dark, so we turn the lights on.
So speaking about illuminating people, I was wondering if today you were starting your investing journey, what would you do?
Terrible segue, that too.
I know, but I try what I can.
Knowing what I know now, I would have taken the Merton formulation. I would have simply gone 100% into stocks and had a small emergency fund. And, I would be wealthier now. Would I be any happier? I don't think so. I have enough, and that's, I could have had a higher rate of return. Would I be happier? I don't think so. So no, I wouldn't have done things terribly differently.
But even with your projection of like the next 100 years could be, or next 30 years could be a bit choppy for stocks, you would still go 100% today.
Yes. Yeah, because that's the best bet. And you have to understand that, if you're a young person, you actually want a lousy stock market for the next 30 or 40 years. You want to be able to buy all of your stocks cheaply. The best possible sequence is to have lousy returns when you're saving, and then good returns after that. And particularly, you want to have good returns right off the bat as soon as you retire, all right? So in retirement, the best possible sequence is to have high returns early and lousy returns later on. And the worst possible sequence is what's called sequence of returns risk, is to retire and then have lousy returns. That's the real risk of having too much stocks when you retire, because if you're 100% stocks and you have 10 years of bad stock returns and you're withdrawing 5 or 6% per year, after 10 years, you're flat out of money. You're eating cat food. So that's why that's what's behind the recommendation of having a decent amount of bonds in retirement, is just to avoid that sequence of returns risk.
Can you think back to when you started investing and what the kind of tone or vibe was at that point? Because we've been a little bit negative and we're going to hopefully get a little bit more positive in a second. But yeah, what was it like when you started?
It was awful. I started saving and investing in the late 70s. And
that was probably the worst time to be an American investor, would you say?
Exactly. Yeah. Between 1966 and 1982, the real return of U.S. stocks was zero. Right? Now, that wasn't as bad as bonds. Bonds were even worse. And people were terribly negative about stocks. Why would anybody want to own stocks? Well, right now we're dealing with the opposite situation. You go back 50 years, what year are you in? You're in 1975. That was the absolute bottom of the U.S. stock market for a period of 10 or 15 years. And the return of U.S. stocks since 1975 has been spectacular. I don't have it in front of me, but I'm guessing it's around 8% per year. People think now that stocks do nothing but make money. Okay, people will tell you now that if you are not 100% in stocks, that every penny you have in bonds will hurt you. And everybody brags about being 100% in stocks. Well, that's pretty much the kind of zeitgeist you see right at the top of the market. That's not what you see when it's the best time to invest in stocks.
You've mentioned about 3 different times, like indicators of market tops. Do these tend to work? Like, for example, you said if the Lyft driver is telling you about crypto or like stocks at an all-time high, do your indicators tend to, over time, have they come through?
No, you can't really time the market because bubbles can last longer than you can ever imagine. I mean, it's an apocryphal quote from Keynes. He never actually said it, but he gets quoted all the time as saying it, which is that the markets can remain irrational longer than you can remain solvent. Mm-hmm. All right, and that is certainly true. You can't time the market, but it is a useful device to help you keep your head. When all of your friends are buying crypto, the knowledge of history of how things eventually turn out will keep you from losing your shirt.
Yeah, and all of those indicators are kind of vibe indicators, aren't they? Of when it's frothy, what you're talking about, when there's a lot of exuberance, basically. People are learning the language, saying it can never go wrong.
I can guarantee any young person who's listening to this podcast that there will come a time in your investing career over the next 30 or 40 years when you will be told you are an idiot for investing in stocks.
Yeah. I've seen the literature around the lost decade for the American market between, say, 2000 and 2009, and people were like, equities are done in America. Don't touch this stuff. And it's almost the day after they just went on the biggest tear, the longest bull run in history.
There was always a period in the United States when the term junk bonds becomes an epithet. And we haven't had a period like that for 20 years, but, there'll be a time. when that happens. You shouldn't be buying junk bonds then, because you'll make money doing that. But when junk bonds become an epithet, it's usually a better deal to buy stocks. And so, there's I've written this book, 4 Pillars of Investing. Please, it's really tacky when an author plugs his own books, but the 4 pillars I will talk about, which are theory, psychology, history, and the business. And 2 of those pillars have books written about them that everyone should read. The book that everyone should read is Jason Zweig's Your Money and Your Brain, which is about the psychology of investing. And the book on history that everyone should read is Ed Chancellor's Devil Take the Hindmost. Okay. And there's another book which is Americans should read if they get into it. It's a book by a guy named Mark Higgins called Investing in U.S. Financial History, which is will give you the same field. And if you know those 2 fields, if you know the psychology and you know the history, you are well on your way to success.
Yeah, we had Ed on. He was great.
He's a national treasure for you guys. He's great.
Yeah, he's funny as well. He told us he wanted to have a fight with Martin Wolf, if you know who Martin Wolf is, the Financial Times. he was like, we want to set up a boxing match and have a scrap with him because they disagreed, and he was like, oh yeah, I'd have a fight with him, like a boxing match, or yeah. So yeah, he was great. Yeah, we had a good time. Yeah. His episode did really well as well. But yeah, it was his theory around interest rates and how a lot of pain was to come, was basically his kind of argument, that we don't know what cracks that had caused. And as long-term rates creeped up, because the trend for 30 years had been, they'd been coming down to negative real rates, as we come back up, he felt that would cause a lot of issues within the economy. And he was he'll happily sit there and go, any day now, I'm going to be right any day now.
Well, yeah, Jeremy Siegel, I mean, we've made some critical remarks about him, but he's made some very good calls in his career, and the best call that he made was it's 2021, early 2022, and Trump and Biden did a good job together of saving the economy with the stimuli that they put out there. And the interviewer asked him right at the end, I think, of 2021, well, who's going to pay for all this? And he just had one word. He said bondholders. And he was not only he was right, but he was precisely right at precisely the right time.
Yeah, you said it was tacky.
And that story is not done either.
No. I mean, like you say, it was decades-long trend of declining real rates. So we cranked them up in the last couple of years. It's going to take a while to see what the lasting effects of that are. So I do think that Edward Chancellor's probably right, just maybe wrong right now. Yeah.
You want to talk about long-term pain. Between 1940 and 1980, the return of both UK and US long bonds, the total return was a real loss of around 60 to 65%. That's a 40-year return, total return minus 60% over 40 years.
Yeah, that would...
I'm not, yeah. Well, if you're 100% equities, you don't have to worry about that.
Yeah. Well, this is what I do the short-term bonds through, like the money market funds, essentially. That's where I keep my emergency funds, so I can access relatively good rates, because I just find that a lot of the banks scalp you on the rates. So I don't mind the short-term stuff, but I've never really looked at the long-term bonds. I never really understood why people buy them. And you said,
don't.
Yeah.
Just don't even go there.
Okay, yeah.
We're all singing from the same hymn sheet.
Yeah. And you said that you think it's tacky to push your books or to talk about your books, but we can. And I think you've shown today that you're amazing at communicating these ideas in a language that people can understand. And I think that's because you're self-taught. And in the description, we'll link some of what I think are your best works. And I would really recommend that people check them out, because you're very talented at what you do.
Well, thank you.
It was a great episode, wasn't it?
Yeah.
Yeah. Everybody's got imposter syndrome. Even the people who you think are the best in the game doubt themselves. And I reckon the more competent you are, the more you doubt your ability. Just, you want to be like you, mate, just blissfully ignorant of how crap you are.
I mean, that's the thing. People are surprised that I have imposter syndrome and I get nervous about things. People are like, oh, you look so confident. I'm like, nah, I like, behind the scenes, I shit bricks. But
that's all right. You could say it. Yeah. You could say it. But like basketball.
No, the podcasting, like replying to YouTube comments, like everything. It's like everyone, outgoing people, we've all got a mask on. Like everyone's got insecurity issues at the end of the day.
That's down to a T.
Hey.
No, there you go. Ended it right there. We're not even going to tell you to watch another episode. You just need to listen to this man today. That'll do. That'll do, pig. That'll do, pig.
Give me babe references.
You know the babe reference?
Of course I know it's a babe reference.
I like the little mice. I like these things. Do you know what I mean? What are they?
No, what a film, mate.
Yeah.
What a film.
Babe in the City can get in the bin now.
Yeah, no, that was trash. That was trash.
What's that about?
Steaming pile of trash.
Yeah. That'll do, pig.